Property, home of Super Prime, where you can find informative, educational and entertaining content covering all aspects of property.
Hello and welcome to the London Property Podcast. I'm your host Farnaz Fazaipour, and today we're in conversation with Alan Kennedy, again back on our show, who is an expert in taxation. He started his career with the HMRC and has now moved on to advise high net worth individuals either before they buy their properties or those who own property in the UK to make the most of their taxes. Welcome back, Alan.
Hi, Farnaz. Good to be back. Thanks.
So, with it being tax season, we thought it would be quite topical to have some basic conversations with you for our listeners on what they need to know, both on a personal level and on a company level. And let's talk about buy-to-lets. So, should we start with those who own properties in a personal level and what they need to be aware of when they're preparing for their taxes, what's deductible, what's not deductible, and just making sure that they're prepared, if not now for this year, but certainly preparing for next year?
Yeah, sure. Well, I think for people who own portfolios of properties in their own name, usually the big issue is whether they've got some bank debt or not. And as many of the listeners will already be aware, there is a restriction, unfortunately now, for interest deductions, which means that interest gets a tax deduction at a value of 20%, but the rental income itself will be taxed at the marginal rate of the owner of the property, which in many cases might be 40% or even 45%. So you get a very unusual situation that can develop where you might have a rental property, for example, that just breaks even because of the interest costs and the other costs on the property. So you're not actually making a profit at all. There's no money left after all the expenses have been paid. But if you're a 40% taxpayer, the interest element, because it's only deductible at 20%, you will actually end up with a tax bill, even though you've not made any money. So that is a real red flag for people that they need to be aware of, particularly if you're thinking about investing in property for the first time. If you're already in that situation, it would be great if you could move to a company owning the property. Now, that's not straightforward, but the advantage of a company is that the interest will be deducted at the same rate as the income is taxed. So you don't get this uneconomic consequence of bank debt causing you a problem. It's not simple, however, to move property into a company. There'll be capital gains tax consequences and there'll be stamp duty land tax to pay. But there is a way to do it, but only if you have the right circumstances. So if you're someone who's got a portfolio of properties, and broadly speaking, you're working at least 20 hours a week to manage that portfolio, then it can be possible to incorporate and not have any CGT when you do that, because there is something called incorporation relief for a business. It's a bit of a hot topic with property as to whether people are actually doing enough to be treated as a business. And there's been some tax cases on this, but that can solve the CGT problem. For stamp duty land tax, bizarrely, even if you incorporate, there's no automatic relief unless you have a partnership. And as we know, lots of people just operate on their own. And it can be possible, particularly in the situation of a married couple, for example, to move into a partnership. And if you do that on a genuine and proper basis and you run the partnership for a reasonable period of time before you incorporate, then you will get the relief from SDLT. But for people who are starting out in property for the first time, I think company is probably the recommended way to go in most cases.
Yeah, no, absolutely. And isn't there also, if you've got debt on a portfolio, is there something about that when you're in a partnership to try and move over into a company to avoid SDLT?
Yes, the SDLT is payable on debt. So if you're giving someone an asset in the form of property, but at the same time you're asking them to accept the debt, then there will be SDLT payable on that. But with the incorporation relief, it can be possible to avoid that too.
Okay, good to know, because we're feeling it in the rental market that actually, and I don't know whether this is the result of individuals being, squeezed on their cash flows, but we're feeling it in the rental market that there is actually a shortage of stock. And I wonder whether people have now started to react to this situation of being, taxed heavier really as individuals than as corporates, because the rents have gone up. I think 13.8% was something I read yesterday. So there is really having an impact.
Yeah, I think it's certainly made buy-to-let less attractive for individuals. And some people, I guess, just find the concept of starting a company, maybe for the first time, a little bit alien. And maybe that stops them stepping into the market and offering properties for rent.
And if you are to set up a company, because we all know that when you're going into a buy-to-let situation, you need to get all your numbers right and make sure that everything makes sense. But the stamp duty is higher for corporate purchase. Are there any reliefs for genuine rental investors, or is there not such a thing?
Well, the stamp duty for a company, that it will always pay the additional 3% surcharge. But for an individual who's going into buy-to-let, it's unusual, I would say, for them not already to own a property. So they will almost invariably have to pay the additional 3% themselves. So I think in that sense, it's neutral. One disadvantage, or one of the disadvantages of a company, of course, is the extraction of profits. So if you are making profit, the company will pay corporation tax, and that's currently at 19%. But then as an individual, if you want to take that profit out, you're going to have to pay dividend tax. And depending on your tax rate, that could be as high as 39.35% on the dividend if you're a 45% taxpayer. If you're a 40% taxpayer, it's 33.75. So the overall tax burden then becomes quite high, and you have to decide, when you're looking at personal ownership maybe versus company, is this something where you want to roll up the profits, for example, or will you need to take the money out every year? Because even with the restriction on interest deductions, it still might be cheaper in the end to have the money available to you rather than having to take a dividend. And the other point, of course, is the capital gain at the end. So if you're going into maybe a single property investment and your plan is to rent it for 5 years and then sell, then you're going to pay capital gains tax at 28%. So you'll realize your profit at 28. If you do the same thing in a company, then again, we'll have the company paying corporation tax when it sells the property, but you still have to get the money out of the company, and you'd have to liquidate the company at that point and probably pay another 20% CGT on the liquidation proceeds. So having an eye on the end game and how much of a portfolio you're going to build, I think will influence how you structure it from day one.
Yeah, sounds like you've got to make sure you get advice before you do any of this stuff. So on the subject of capital gains, there's different ways that they look at capital gains, right? You've got some things that you can deduct, and then there is a difference between trade income, short-term, long-term ownership. Is that something you can talk to us about?
Yeah, so the main issue with property and what's deductible usually revolves around whether it's a capital expense or just a revenue expense. And the simplest way to think about this, because people do get confused about it, is for capital gains tax purposes, you can deduct anything that is an alteration, an extension, or an improvement to the property. Running repairs, you will deduct in your profit and loss account every year against your rental income. But it's things like, a dormer extension to a bungalow or something like that, or putting an extra basement in. Those are extensions, improvements, and they all count for capital gains tax purposes. And obviously, it's not just the fabric of the building; it's all the professional costs associated with that come into play, and really form part of what the asset is at the end. And if it's represented in the form of that asset, you have architects, planners' fees, legal fees, etc. They all form part of the base cost for capital gains tax purposes.
As does SDLT.
Yeah.
So you can deduct that as well. And then, as you say, the other things like the running expenses, the wear and tear, these all get deducted on an annual basis from your profit and loss. What about enhancements to the property that are requested by tenants? So tenant says, I'm not going to rent that house unless you paint the walls in this color and, change the cabinets.
Yeah, that, painting the walls a different color, that's not going to be regarded as a capital gains tax base cost, but it will be a revenue expense that you can deduct in the year. And with the cabinets, etc., we have the wear and tear allowance regime that can be used for things like that, where you get a straight line deduction for that over a period of time.
And are there any? Does the revenue look at things differently? Because you also have developers, for example, where they buy a property and they fix it to sell it, and that market, is under a lot of pressure for a lot of different reasons. But are there any tax incentives to actually encourage people to provide housing, to buy things to fix, to sell? Is there, something that if you are a bona fide developer, you can benefit from?
I think if you're a developer, again, if we look at company versus individual, people would invariably go down the company route because the individual will be chargeable to income tax on a development. That's the key thing. It's not capital gains tax. There are a lot of arguments, lots of tax disputes that we've come across over the years where people are just unaware of this rule and they take on a project and they expect and they budget for capital gains tax at the end, and then suddenly the accountant, or maybe it's HMRC, even says, actually, no, you don't owe us 28% tax, you owe us 40% tax or 45% tax. So de-risking that through a company is probably the first thing that I would say. If you are a trading company, if you have a holding company structure, so you don't own the shares directly, but you have a holding company above that trading company, it can be possible, if you've got someone who's prepared to buy the shares in the company instead of the property itself, because maybe they want to save the SDLT and only pay 0.5% stamp duty on the purchase of the shares instead of maybe a blended rate of 10% or something SDLT, then they can save money with the SDLT by purchasing the shares. And if the holding company sells a trading subsidiary, it's possible that that can be completely exempt from corporation tax at that point, which would then allow you to liquidate the holding company and take all the value out at a flat tax rate of 20%.
So I've got myself a note here, which I was hoping you will clarify. But there's no difference in taxation for short ownership and long-term ownership. I know in France, for example, if you hold a property for 30 years, then you become free of CGT. And I know that here we've got the principal home being, the most tax efficient way of holding a property. But there's nothing about short-term and long-term that.
No, there's nothing specific. I think in France now, the maximum period for the sort of tapering of the CGT rate, I think it's about 22 years or something now. But in this country, really, the length of ownership influences how HMRC look at the transaction for sale. So if you have, for example, developed a property and you sell it within 12 months, even if you had the intention of renting it out and you change your mind and someone makes you a fantastic offer and you decide to sell it, because it's happened so quickly, there'll be an argument. If you're not using a company, if you're an individual or a partnership, they'll have an argument with you about, is this really capital gains tax? Didn't you always intend to sell it? So the length of time that it's been owned influences the attitude of the tax authority as to whether it's really an investment transaction or a trading development transaction.
Right. I mean, we sort of feel a little bit under attack from HMRC since 2013, I think, in prime central London. Have we got any other surprises in store for us that we should be preparing for?
I hope not. I hope not. I mean, it's worth saying, it's this time of year where it's April 22. So it's a big event in the world of ATED right now because we're at the 5-year revaluation of all the properties for ATED purposes. So anyone who's got a company that's liable to ATED needs to get their property revalued as at 1 April 2022 if they think they're going to be anywhere close to one of the edge of the HMRC bands, to avoid any potential dispute about which ATED band and therefore how much money it's going to cost them every year. And obviously the ATED filings need to be done by 30th of April each year. So that's kind of on people's minds right now. I think just as a general reminder, it's not that long ago that we got the extension of non-resident capital gains tax to non-residential property and to what we call property-rich companies, where 75% of the company's value is from UK real estate. Now, the capital gains tax only came in from April 2019. If people have not already had a retrospective valuation at April 19, I'd recommend they do that as soon as possible, because again, in years to come, properties will be sold, companies will be sold, and everyone will be scratching their heads as to what was our capital gains tax base cost. And if you're getting a valuer, in 5 years from now, you're selling a property, 2027, the valuer says, this is what I think it was worth in April 19, this is your base cost. HMRC valuer comes along and says, well, I've got a different opinion. Then you've got what I would call equality of arms. You've got two people arguing about what something was worth 8 years ago. If you get your valuation done today, if you haven't already done it, then you've got a valuer who did a retrospective valuation, but only 3 years after the event. It's much more difficult then for the HMRC valuer to say, well, actually, 5 years after that, I'm going to dispute what you said 3 years ago. So it gives you a much stronger position of certainty that your valuation will stand up and will be much more difficult to challenge by HMRC.
Yeah, and obviously this is payable on properties that are not being let out, that are held in corporate names and are kept empty.
Any property. I mean, it's land as well, undeveloped land. Will also come into this. So any interest in land at all that's sold in the UK now by a non-resident is liable to this tax. And we've had a minor relaxation of the filing requirements for capital gains tax for non-residents. So it used to be they had to file a return within 30 days of the transaction. That's now been extended to 60 days, but it's still a really tight time frame. And it can work slightly different for companies because they base it on their accounting period sometimes.
Right. Okay. Well, and you've got a pending talk that your company's doing about this register for overseas landlords, which will be a whole other conversation to have. But just touch on it briefly before we say goodbye, and we will be sure to tap into your intel on this on a future show.
Yeah, of course. So this is part of what they're calling the Economic Crime Bill, which I think was brought forward about 12 months because of the war in Ukraine, because there's a realization that there's a lot of oligarchs who've got high value UK real estate, and the government is not always happy simply knowing that, for example, there's a BVI company that owns a large property in Knightsbridge, but who really owns it? So this is going to bring transparency. So any overseas company that owns UK real estate of any kind will have to, on a register at Companies House, disclose who the beneficial owners of that company are. And that's going to obviously bring a lot of difficulties for privacy. And it's not restricted to any particular nationality. So it's going to affect everyone. So high profile people, I know in the past, Emma Watson, the actress from the Harry Potter movies. She had a problem with a stalker, and for that reason, her property was owned by an offshore company so that no one could actually find out where she lived. For people like her privacy is blown. So there's a lot of collateral damage, but it will also have an interesting effect, possibly for inheritance tax purposes. Lots of foreign owners don't actually realise that since 2017, they have an inheritance tax liability. If someone dies owning shares in an offshore company that owns UK residential property, they actually should pay inheritance tax. But a lot of people just don't know that. And obviously, HMRC don't know who owns the offshore company, but very soon they will. And that means that a lot more inheritance tax will probably start getting paid. People will think about the need to take out life assurance to cover that risk. So there's kind of a ripple effect that's going to happen from this. We also think, although the bill's only in draft, that for offshore companies that own property, which are then owned by a trust offshore, because no one can actually own a trust, it's difficult to see how anyone can be named as an owner in those circumstances. So it'll be interesting to see if the final version of what becomes law will pick up on that point, or whether that will remain perhaps a grey area.
Well, we'll be sure to come back to you with a much more in-depth conversation on this topic, and definitely make sure to be at your event on the 4th of May. Thank you so much, Alan.
Thanks, Farron.
Thanks for listening to the London Property Podcast. Head over to londonproperty.co.uk and subscribe to our newsletter to receive latest updates.